This is the Daily Market Rundown live from the Tradelo trading floor. It's January the 31st. Some highlights from today's show. 25% tariffs are incoming for Canada and Mexico. Retail investors bought the dip in size, and gold sets a new record high. Good day, traders, and welcome to the penultimate trading day of the month. With that in mind, let's have a quick look and a discussion and talk about the key movers for the month of January. If we start with the indices, we can see very much that the S&P, Nasdaq are both up in the region of around 3% on the month. But it's been all about DAX and Europe in general. I mean, DAX is up just short of 10% on the month, with Kakaron, FTSE all up in the 6-7% range for the month. So it's very much been a theme of outperformance by Europe, which is highly unusual. But we did talk about this yesterday. It's very much being driven by a combination of factors. One, Europe is perceived to be cheap relative to the United States, as well as, of course, we do have a ECB that is far more aggressive in the cutting cycle. Turning our attention then to some of the other key movers this month, of course, we have Bitcoin up 11%, and then gold has been a star outperformer. We'll talk about that a little bit later on, but we're up 7% in gold for the month of January. So some really big movers to start off the year, and obviously that is going to set the tone for, of course, what comes next. Now, turning our attention to some overnight moves, we start off, of course, we did have quite a bit of volatility into the close yesterday, but we can now see that US indices have closed that Sunday gap up. What that means effectively is a round trip where we are pretty much looking to close the week out flat. Now, of course, we do have month end today, so a lot can still happen, but do just factor in that, it has been quite a volatile week. Now, let's turn our attention to our first topic of today. It's all about Germany. Sinks even further. This is the CPI data out today from the key regions of Germany, and it wasn't just small misses in Germany, it was significantly small misses, and this comes off the back of that very, very weak negative GDP print we had, of course, yesterday. This points just to further negativity coming out of Europe. Lagarde yesterday, ECB, came out. She sounded awfully confident about this idea that, yes, we're going to see a little bit of weakness early on this year, but some form of a rebound is expected later in the year. And I sort of sat there scratching my head saying, I don't get it how you suddenly, after 2 years of recession in Germany, how are you suddenly going to turn that around, Madame Lagarde? Obviously, they have got better forecasts than what I do, but things are not looking good in Germany. We now do have not just negative growth, we have inflation that's dropping off a cliff. And you know what that points to? That doesn't just point to a stagflation environment. That starts to point to a very, very aggressive recessionary environment. So keep a close eye on that. I think that's something definitely to pay close attention to. The other key thing, and this sort of justifies this really sort of negative tone in Germany, is look at that unemployment rate, 6.2%, and where is it? It's right back to COVID levels. Okay, factor in we're not in COVID times, and yet unemployment is right back to where it was during COVID levels. Okay, this is a really significant chart. And again, like I said, recessions don't typically turn around off a dime. They don't just suddenly stop because you've cut interest rates by 125 basis points, ECB. The reality is that this is going to get a lot worse, and it's going to force the hand of the ECB. And there is in the play, we've been talking about this euro back to parity play for some time now. That play is very much on the cards in the course of February. So keep a very close eye, of course, on the euro. Now, turning our attention to SoftBank, of course, we have to always pay attention to SoftBank because we know that when they talk, they have got some serious money coming behind them. And effectively, they are looking to do a funding round for OpenAI. Of course, this is key because why? Well, OpenAI has been in the news the last week, given what's going on with DeepSeek and Alibaba. They're looking to raise at a valuation of 300 billion, which, given that they just recently did a raise of 150 billion, it just showcases the amount of money and the amount of sort of positive sentiment towards OpenAI and AI in general. Now, Will the deal get done? Well, it sounds pretty rich. It sounds like someone's going to be buying at very expensive levels, and with all the uncertainty now around DeepSeek and of course Alibaba and how much it costs to train these models, it is just a very interesting time to do a raise. So I think the key reason why I'm mentioning this, I think the question mark we want to know is, will they do the raise? Will they get the funding led by SoftBank to actually do this raise? And I think that's going to be a key question. If they can't get the funding, that's going to tell us a lot about investors' appetite for very expensive AI, given the current landscape. Okay, so this is one to watch. It's one of those that could really much drive sentiment for AI in the near term. Of course, long term, we know that AI is very much the future. Then a key article, this is a wonderful one. US retail investors dive into the tech stocks. Why wouldn't they? We, of course, had Nvidia down 16% this week at one point, 17%. We obviously had Microsoft down 6.5% yesterday. We had a number of the other tech stocks also down quite a bit this week. But in reality, the retail market has lumped in. They've lumped in, of course, at a time when there is uncertainty around AI. What does that mean? Does it mean they're right? Does it mean they're wrong? I don't know. But what it does mean is that there's quite a lot of fresh money that has just come into the market. So what that means for us typically as traders, if you go look at that S&P 500, particularly on a 4-hour chart, you'll see something like this, where we've effectively just slowly rotating higher. And if retail investors now bought in and around that area, what that tells us is that we're going to have some very good stop side opportunity should we take out those lows in the S&P. So what it means is that, well, yes, we are very much bullish on the week. The weekly candle is going to look quite bullish, and I would expect some sort of a challenge for record highs next week, but very closely watching those record highs, and as I said, watching those weekly lows in the S&P. Should we take those out, a lot of people are going to find themselves underwater, having bought at very expensive prices. Now, just to wrap, of course, and talk a little bit about this week, we have a summary of the Mag 7, and we can see it's been a very mixed week. I mean, Nvidia is still down 12.6, and don't forget, Nvidia is the biggest company in the world. Second behind them, Microsoft, second biggest company in the world, down 6.5% on the week. So is it all clear? Absolutely not. Do not think it's all clear. There's a bit of rotation going on. You know, value seems to be doing a bit better this week. Of course, like I've shown you, European equities seem to be doing quite well this week. And of course, Apple, very much up this week. But don't forget, Apple's been the star underperformer for the course of the last couple of months. So I wouldn't look at that as, you know, a knight in shining armor, Apple to save the Mag 7. It's very much the only one that's holding up right now is Meta, of course, trading at record high. So again, got to keep a close eye on that Mag 7. It is showing underperformance. It is showing weakness. It isn't showing the leadership we've seen in the last 2 years. What does that mean for the indices? Well, we'll have to wait to find out about that. Now, a quick note on our sponsor, Tradelo Trading. Tradelo provides futures traders with an all-in-one trading application. The tools within the application include automated risk management, trade journals, data analytics, premium education, verified leaderboards, and a collaborative trading community. For more details, click the link in the description and subscribe for a free version of the application. Let's now move across and talk about the key chart for today. We have got some key data in the form of PCE, and that is going to take the focus of traders. It's expected to come in around 0.3 on the monthly headline. Now, what's interesting with PCE and why the Fed likes it is because of its lack of volatility. It's a little bit cleaner. And what we can see, and this is the key takeaway from this, of course, we started last year off a little bit slowly, but we can see is that very much 0.1, 0.2 is sort of very much what the Fed's comfortable with. Okay, today we expected to have a 0.3, a little bit higher than expected. So very much a case of a 0.4 print is going to create some head scratching. There was an article out this morning talking about how a lot of US companies have been stocking inventory. They're buying very aggressively to load up on inventory ahead of incoming Trump tariffs. Don't forget as well, we did have a lot of positive sentiment post US election last year. So there's a lot of potential for a hot print in the PCE today. Keep a close eye on that. 0.4 or above. Don't forget the markets right now are, you know, sort of talking about rate cuts for June. I don't suspect a hot print today changes that too much, but it does confirm that perhaps the Fed is going to remain on pause for somewhat longer than most people anticipate. Okay, to the downside, anything less than 0.1 or even a 0 print is going to get some head scratching. It's going to be very positive in terms of sentiment. Why? Because very much the base case is for a soft landing, i.e. that's the scenario where growth accelerates and at the same time inflation comes back to target quicker than expected. Don't forget, the Fed's talking about inflation only coming back to target next year, 2026. So any weak prints in inflation will be absolute gold, not just for the Fed, but for the markets. Okay, if the Fed can cut sooner than June because inflation's coming back a lot quicker, that's going to be taken as a real positive for the equity markets. Okay. Let's turn our attention now to our key chart. It's gold and it's shining once again. It is back at record high levels, and this is a positive for the markets. Of course, what it does mean is that we've got to keep a close eye on it. What we can see is that we're a little bit overbought into this record high, which is very unusual technical pattern. We can see how steep that rally has been. There's been very little retracement in terms of the gold market, and we can see we're quite some way off that 20-day average. This sort of $80 spread between the 20-day average and current price is quite wide. It's very, very unusual, and typically when we move into this sort of price discovery mode, you don't want to see it from an overbought territory. Okay, what that means is I do expect a little bit of two-way trade, a little bit of volatility. If we get below that 27.90, don't be surprised to see it just come off a little bit, $30, $40, $50, and a little bit of two-way trade ahead of some form of a breakout. Remember, for markets to move into sort of price discovery mode, they do need a catalyst. Gold up 6.7% in January alone is quite an aggressive move. Okay, we're not likely to see a lot more acceleration unless, of course, we do start to see inflation prints accelerate to the upside. And of course, we do have the PCE data out today. So keep an eye on that gold. I do think it has some potential for a little bit of a flush out of some of those very aggressive hands. Now, a pattern that a trader shared with me yesterday in the Discord community, and I think it's a fantastic pattern. If we look at gold back in 2023, this was the previous record high. It was actually a double top, and what we did was we staged a really good strong close. Okay, if you look at this day here, it was an open at the low, close at the high, very, very strong close into record highs. Next day market extended, but rejected very aggressively. Okay, same very aggressive shallow or very steep trend line with very shallow pullbacks, very similar pattern play, and notice, of course, we had a very significant spread in terms of the 20-day average versus current price. Okay, it's almost an identical setup, and so hence why we lean on this pattern, we learn from past, and we make sure we can take advantage of it. The key level, like I said, we're looking for is a move back below that 27.90, particularly over the PCE, should perhaps force a little bit of profit taking back down towards that 27.65. So a good opportunity to pay very close attention to. That's then a wrap for the week. It is, of course, a month end today, so there will be some of those traditional month end flows. Keep an eye on the bonds, a little bit of a flattener going into the month end. Don't forget, of course, we do have the 4 p.m. dollar fixing, where we do typically see a little bit of dollar sell side flows. Otherwise, as always, don't be surprised to see the equity indices continue sort of just grinding a little bit higher. It's going to be very much up to the VIX as to what happens. But if you go look at the close yesterday, there was quite a lot of volatility given the Trump tariffs. So don't be surprised to see a little bit of pairing of risk into the weekend, given we do have, of course, Trump deciding on Mexico and Canada tomorrow. All right, that's it out there for today. Good luck out there. Manage that risk. Go make some money.